Hi, I'm Jain, founder of FinTech ActiveAllocator. We let investors analyze existing allocations, discover inefficiencies, and create bespoke portfolios in less than 10 minutes. So today, I'm going to argue that the widely prevalent practice of model portfolios, one size fits all, is a bad idea. The notion of putting retail investors in cookie cutter, mass-produced, standardized buckets of allocation is antiquated 1990s thinking. In 2018, it is akin to paying a doctor expensive fees for an over-the-counter pain medicine prescription. So it's good for the financial advisor, but bad for investors. Advisors favor model portfolios for it makes life easier for them. I mean, how hard can it be to go through the motions of a KYC and decide on conservative, moderate, balanced, growth, aggressive risk profiles and slot clients neatly there? It reduces the investable universe to the most popular subtypes of equity and bond classes, and advisors love it, for it automates implementation. It permits scalability in managing assets. It eases trading and periodic rebalancing. It helps express house views, as well as reduces portfolio construction and diligence complexity to just a few products. So despite what you hear, the truth is, model portfolios are very similar to each other and often near identical, much like a rack suit that comes in different sizes. So these models can be constructed in minutes, and then these are often back-tested to provide false comfort with a disclaimer: past performance is not an indication of future results. I mean, I never met a back-tested portfolio I didn't like. So not to put too fine a point, but these are terrible for the investor. They do not constitute a personal recommendation. They do not properly consider the investment objectives, investment strategies, financial situation, the changing needs of a client. Moreover, many are based on flawed assumptions that can often result in materially different results than what was originally envisaged. So for strategic asset allocation, backtesting model portfolios is a meaningless exercise. After all, model allocations are based on estimated forward-looking return, risk, correlation, inflation, and risk premium assumptions that, when realized, one knows full well in hindsight. Model portfolios work in an ideal world where there are no particular investment time constraints, where the supply and demand for investments is always in balance, and where client preferences are static and largely similar. Also, they oversimplify and do not consider changing risk exposure. So it's no surprise that model portfolios almost always shirk active management and recommend broad passive asset class exposure. After all, active management requires resources to implement. It is intensive and costly. For instance, it implies what we do, better look through by aggregating granular position level data and classifying such data properly to arrive at true underlying sub-asset exposure. And these model portfolios are quite unable to bring active and passive, liquid and illiquid, traditional and alternative investment analysis together in a seamlessly integrated framework. They don't account for real-world issues such as stale pricing and returns returns measurement, unique risks within active management that differs from those in traditional investing, in isolating the effects of illiquidity in portfolios. So rather than resolve they ignore heterogeneity in complex sub-strategies, as well as dismiss soft qualitative special manager evaluation considerations. So at ActiveAllocator, we do not believe in the model portfolio approach. We let you create bespoke portfolios in minutes. Check out our website to learn more, get in touch with me, and thanks for listening in.